Students, today we are going to learn financial management part 2. In part 1, we completed Walter model growth firm problem. In this class, we are going to learn the same Walter model normal form. Yes, let me see the problem. Sum number 2. The earnings per share of Nadal Limited are 15. So EPS is given rupees 15. And the rate of capitalization, that is cost of capital, is 12%. The productivity of the earning is 12%. What do you mean by productivity of earning? It is nothing but rate of return on investment or internal rate of return. Okay. Compute the market value of the company share if payout ratio is situation 1, 20%, payout ratio in situation 2, 50%, in third situation, payout ratio is 70%. Which is the optimum payout ratio? Yes. Now we are going to solve the problem. Situation 1, payout is 20%, which means retention is 80%. We want to find the price of equity share under Walter model. Here the problem in relation to the normal form. Here R equal to K. R means internal rate of return. So productivity of the earning is 12%, that is R 12% equal to K. Rate of capitalization is 12%. So internal rate of return and cost of capital both are same. We are going to find the price of equity share under Walter model. The formula is D plus R by K, open the bracket, earning per share minus dividend per share divided by K. First we have to find D. D means dividend per share. D means dividend per share. The formula is payout into earning per share. Payout ratio we know 20%. Earning per share given in the question 15. So our dividend is 3. Then we have to find R. R already we learned 12%. K, cost of capital, that is also 12%. Earning per share already we know, that is 15%. Now we can apply the formula. D already we found 3 plus R 12%. 12% we can write it as 0.12. 0.12 divided by K. K also 12, we can write it as 0.12. Earning per share 15 minus dividend 3 divided by cost of capital also 0.1. Now we close this. First we should divide. 0.12 divided by 0.12 will get 1. 15 minus 3, 12. First we should multiply 1 into 12. So 3 plus 1 into 12, 12 divided by 0.12. So our answer is 15 divided by 0.12. 15 divided by 0.12 will get 125 per equity share. This is situation 1. This is situation 1. Payout ratio 20%. When payout ratio is 20%, the market price of the equity share rupees 125. Then we should move to situation 2. In situation 2, payout ratio is 50%. Payout ratio is 50%. Here we have to change only the payout. With the help of that we can change the dividend also. We have to find the dividend. Remaining things are same. So dividend per share. The formula we know, payout multiplied by EPS. Payout 50%. Our EPS already we know 15. So 50% will get 7.5. Now we can apply the formula. So the price of equity share under Walter model, further the formula D 7.5 plus R 0.1, K we know 0.12. Open the bracket, EPS 15 minus dividend 7.5 divided by cost of capital. First, earlier I said first we have to divide. We'll get 0.12 divided by 0.12, we'll get 1. Then deduct 7.5 from 15. We have to deduct dividend from the EPS, we'll get 7.5. First we have to multiply 1 with 7.5. So our answer is 7.5 plus 1 multiplied by 7.5, we'll get 7.5 divided by 0.12. So here 7.5 plus 7.5 will get 15 divided by 1.2, we'll get 125 per equity share. So if payout ratio is 50%, we got 125 as market price per share. Then in situation 3, our payout ratio is 70%. Earlier I said we have to change the payout ratio. By changing the payout ratio, we can change the dividend per share. So dividend per share equal to payout multiplied by EPS. Payout we know 70% of EPS. So 15 multiplied by 70% will get 10 rupees 50 paise. We can apply the formula. Dividend per share 10.5 plus R divided by K. R is 0.12. K is 0.12. Open the bracket. EPS 15 minus dividend per share 10.5 divided by K is 0.12. Earlier I said divide 0.12 by 0.12, we'll get 1. Then deduct 10.5 dividend per share from the EPS, we'll get 4.5. 10.5 plus 1 into 4.5 divided by 0.12. So 15 divided by 0.12 rupees 125 per share. When payout ratio is 70%, the market price of equity share is as same, rupees 125. In normal form, R equal to K, that is R return on investment 12%, cost of capital is 12%. So in normal form, we have to write analysis. This is normal form, which means R equal to K. Here, at any payout ratio, the price of share remain same. So the payout ratio which will not affect the price of equity share under Walter model in relation to normal form. Students, we completed two problems. One is the problem in relation to the growth firm. Another one is the problem in relation to the normal firm under the Walter model. In next class, we will solve the problem in relation to the declining firm. Till then, bye. And